So what if I told you that one of the best financial reports in a company's history could actually trigger one of its worst days ever on the stock market? It sounds impossible, right? Well, that's exactly what happened to Microsoft. And this isn't just a story about numbers. It's really a detective story, and it uncovers what Wall Street truly cares about. Turns out all the clues were hidden in plain sight.
Okay, let's just start with the headline number. On January 29th, 2026, in just a single day of trading, Microsoft's market value absolutely cratered by over $357 billion. To give you some perspective, that is the largest single-day dollar loss for any company ever. A truly historic, jaw-dropping number. But the reason why it happened? Well, that's the real mystery.
So that's the big question, isn't it? How on earth does a record-breaking loss come right after what looked like a spectacular A-plus earnings report? That's what we're going to dig into. To figure this out, we've got to look past all the shiny headlines and find the clues that were buried deep, deep inside those numbers.
All right, so first, let's just lay out the facts of the case. We need to look at the official story, the one Microsoft presented to the world, and by all accounts, it was incredibly positive. This is exactly what makes the market's reaction so completely baffling.
I mean, look at this. On the surface, everything looked amazing. Revenue? A whopping $81.3 billion, beating what the analysts expected. Their earnings per share, or EPS, came in at $4.14, also a big beat. Microsoft's cloud business crossed $50 billion for the first time ever, and Azure, which is their key growth engine, grew by a massive 39%. I mean, it was a home run on every single metric.
And here you have the CEO, Satya Nadella, just doubling down on all that optimism. The message was crystal clear. Microsoft wasn't just doing well, it was building the entire future of AI and was already cashing in. So, with a report card this good, why the absolute panic?
Okay, this is where our investigation really gets interesting. Because while the market heard the official story, it was listening for something totally different. See, investors, they looked right past that stellar report, and they locked on to 3 hidden red flags, details that told a very different and much more alarming story.
These 3 details completely flipped the script. They turned a story of triumph into one of massive risk, out-of-control spending, and a dangerous reliance on just one partner. These are the clues that solve our $357 billion paradox. So let's examine the evidence one piece at a time.
Clue number 1, a truly mind-boggling amount of spending. What you're looking at here is Microsoft's capital expenditure, or CapEx. You can just think of it as the money they spend on physical stuff, like data centers and servers. And you can see it's not just high, it's actually accelerating, fast. It hit $37.5 billion in just one quarter. To put that in perspective, they are on pace to spend over $100 billion a year just building out the infrastructure for AI.
But the total number isn't even the scariest part. This slide right here shows the real problem. You can think of CapEx in 2 different ways. On one side, you have lease CapEx, which is kind of like renting. It's flexible, and it has a smaller impact on your cash right now. Then you have cash CapEx. That's like building and owning the house yourself. While Microsoft just made a massive shift from renting to building, and their cash CapEx surged by over $10 billion. That just burns through an insane amount of cash right now.
So what's the direct result of that huge spending shift? A 77% drop in their free cash flow from the last quarter. And that's the cash they have left over after paying for everything. To investors, it looked like Microsoft's cash-generating machine was suddenly sputtering out, like the company was just burning money at a totally unsustainable rate to chase this AI dream.
And this leads us right into clue number 2. All of that spending is supposed to buy one thing: faster and faster growth in their cloud business, Azure. But just look at this table. After jumping to 40% growth in the quarter before, it actually ticked down to 38%. And the guidance for the next quarter? It's looking flat, at best.
So here's the key. 38% growth is fantastic for almost any company on the planet, but it wasn't good enough for Microsoft. It missed the unofficial whisper number that analysts were all secretly hoping for. And that sent a signal. Even spending billions and billions of dollars wasn't buying the runaway growth that everyone expected. The law of diminishing returns was starting to kick in.
And that brings us to our 3rd and final clue, which, believe it or not, starts with another insane number. This is Microsoft's backlog of contracted future revenue. On the surface, having $625 billion locked in for the future looks like an impenetrable fortress, right? But the real question is, who are those contracts with?
And here is the big reveal. A shocking 45% of that massive backlog, that's nearly $281 billion, is tied to a single partner, OpenAI. This means that almost half of Microsoft's guaranteed future growth depends on one company that is itself famously burning through cash. So, to the market, this looked less like a strong partnership and more like a huge, concentrated risk.
So, with these three major red flags just waving in the wind, how did the pros on Wall Street react? Well, the official ratings didn't really change much, but if you look a little closer, you can see this really clear shift toward caution and a whole lot of doubt.
You can really see that caution setting in right here. Even the banks that stayed bullish on Microsoft, firms like JP Morgan and Goldman Sachs, they started trimming their price targets. They still saw some upside, but less than they did before. This was basically Wall Street's way of saying, hey, we believe in the long run, but the short-term picture just got a whole lot riskier.
Analyst Dan Ives just summed it up perfectly here. Investors wanted proof that the big AI investment was paying off now. They wanted to see lower spending and higher revenue. Instead, they got the exact opposite: record high spending and signs of slowing growth. This fundamental mismatch is what sent the stock into a nosedive.
So, after the biggest one-day drop in its history, what's the final verdict on Microsoft? Is the stock now a value trap, just doomed by massive spending and super risky bets? Or is this a rare opportunity to buy a world-class company at a serious discount? Let's look at both sides.
The arguments are actually pretty clear. The bulls, they say the stock was just overvalued, and this drop simply removed all the froth, making it a really attractive buy. They point to that $625 billion backlog as a fortress of revenue security, and they argue that Microsoft is simply building the essential foundation for the next decade of tech. But the bears, on the other hand, they see unsustainable cash burn, a dangerous over-reliance on a single, unprofitable partner, and a high-margin software company that's starting to look a lot more like a low-margin, capital-intensive manufacturer.
And really, this is what it all boils down to. This historic stock plunge wasn't just about one bad quarter. It was a referendum on Microsoft's entire AI strategy. The company is making an all-in $100 billion a year bet that it can build the infrastructure for our AI future. The market has shown its doubt. So the only question left is, do you believe that bet is going to pay off?